Hello guys, welcome back to another video. Today we're going to be talking about ASIC mining, and pretty much we're going to be going over if ASIC mining is a good or a bad thing. So obviously there's 2 or 3 types of mining. You'd have CPU mining, GPU mining, and then ASIC mining. The only problem with ASIC mining is that pretty much every time that you have ASICs come onto a network, the network starts to get more centralized into these pools, plus the threshold for actually buying an ASIC gets higher, or at least the machine cost gets higher. And that limits the access for people that don't really have the capital to invest into ASIC mining, or it really limits the access for those GPU miners who might be, trying to save up for an ASIC. And then there's new ones that come out and they're higher priced. So right here, this is all the stratums for Bitcoin mining. At the moment, you can see all the pools, and basically all the transactions are going into this one wallet that you can see here. It does change. I'm not really going to cover this too much, but mainly to say that most of the pools are funneling a lot into one wallet at the moment. And this is where we see the more centralization of ASIC mining. I don't really know if I've got this particularly right after looking at the data. You can let me know in the comments. But mainly what we see is a massive centralization of mining once the ASICs take over. Obviously, with Bitcoin, it is heavily centralized. I know that there is spread out on the hash rate when we look here. However, most of it is held within these top 3 pools. And you can kind of see that on the mempool. Basically, you have Antpool via BTC and then Foundry USA, which are hitting the most blocks out of all of the Bitcoin miners. And the flow, as you can see here, there's not much flow actually going on to other miners that are cashing out necessarily. But most of them, as you can see here, are mined by just a couple handful of pools, and that's where we kind of get into this centralization talk and why ASICs might not necessarily be the most centralized way of mining currently. Obviously, the pools we can't really control, so I'm going to kind of take that out of the factors that we're looking at today, because anyone can set up their own pool, but not everyone can hold this amount of hash rate on their own pool. So we can't really talk about pools manipulating this centralization, but obviously it plays a big role. If we didn't have mining pools, everyone would basically be solo miners. But naturally, we need these pools to kind of facilitate Bitcoin mining at this point, and obviously other coin mining, because the threshold for mining 1 Bitcoin, or at least 1 block, is very high at the moment. So that being said, I'm just going to take you through kind of how this centralization works. I've got a nice little paint canvas here. So firstly, what you have mainly when a new chain starts, so we'll start with 1 block there. You might have it on CPU first. So there's loads of CPUs out there that you can mine with. Obviously, you can mine with anyone that you want. It may not be profitable, but you do have access, and pretty much everyone has a CPU. Whether they are in the computer or on your phone, there are phone mineable coins these days that utilize the CPU. But mainly this is very accessible. Anyone can really mine on a CPU. So that's how the chain starts out. And then normally it graduates over to what you'd have as GPUs. Sorry if this drawing is very bad, but we're just going to go with this as our GPU. So 3 fans there, that looks like a GPU, sure, whatever. We'll just draw it out a little bit more. So you have your GPUs there. The network will progress to GPUs, and then that kind of higher the barrier of entry because you have to buy dedicated hardware. With the CPUs, it's not as dedicated, but you're still going to have to get a hold of the CPU at least. And then with GPUs, you're going to have to do your research, probably spend a little bit more on a GPU just to start mining coins. So once it turns over to GPU, it becomes slightly more centralized, but not that much more. And the real big jump is when it either goes over to FPGAs or to ASICs. So we're just going to bunch them in together. So here is our ASIC, and we're including FPGAs in there. So let's just put slash. I know it's really bad drawing, but that's mainly how a network would progress in terms of mining. I know Bitcoin, that's kind of how it started out as well. It was CPUs, GPUs, and then FPGAs and ASICs. The only problem with ASICs is that they obviously cost a lot of money to buy, and they basically cut out FPGAs, GPUs, and CPUs from the network. So the more people obviously that can mine on a network, the more decentralized in theory it should be. But ASICs do take away a lot of this decentralization just because the amount of money you have to invest in them is high. Plus, it takes away a massive amount of hash rate in terms of the machines that are on the network, because one ASIC could do the work of maybe 10,000 GPUs on the network. So this is the problem that's been there in crypto mining for quite a while. We had with Ethereum, we had GPUs and ASICs on the network, but that was strictly because the algorithm wasn't really allowing it to be a massive thing on the network in terms of ASICs. It was very hard to develop for that. But there were still ASICs. I think it was around 50% ASICs, 50% GPUs, but they weren't as efficient as, what you'd have with Bitcoin, because right now you can't mine Bitcoin with even an FPGA or a GPU or a CPU. So that's that progression that we see there. And mainly it happens obviously because people want to mine more and they want to take more profits for themselves. And then what happens is that all of these ASICs come onto a network, and basically you need a place to go for them to start mining together, because nobody can really afford to buy enough machines, and that centralizes it into a pool. So I don't know how long Bitcoin mining pools have been around, but I'm assuming that Bitcoin mining was the first kind of pool that was developed, and then we had obviously pools for other coins. Normally when a coin comes out onto the market, I'd say when it starts to get released, when in the early stages there'll be pools that open up instantly for them. Obviously with Bitcoin it was kind of a different thing because it was the first of its kind, and then you have pools opening up for them. So you can see how quickly it moves over to a centralized so you can see how quickly a network can move over to a centralized place, even though we're working on a decentralized network. And mainly the whole point is that I'm not against ASICs. I just see that there is a problem with that. Either ASIC prices have to come down, which would, level out the playing field a little bit, which they're not going to, because only a few people can produce ASICs in the world. And even of those few, only a small percentage have very efficient ASICs that they can produce. So it's very hard, as you see here, Bitmain obviously being the top one, Gold Shell, Ice River obviously for the kaspa and Lithium ASICs. You have a couple of other companies as well, IB Link, Jazz Miner, and pretty much the whole list, if we're looking there, is taken up by all of those. You have iPolo. I haven't really used one of these, but you can see that there's a very few amount of ASIC producers, and then a very few that are actually at the top of ASIC producing, mainly being Bitmain. And it's not really a market that needs prices to go down in terms of ASICs, because people will buy them regardless, and those people will have money, and those people that have a lot of money to invest in them normally centralizes the whole process. For example, you have ASIC hosting facilities, so you kind of need to move your ASIC to a place with better economics in terms of the electricity price, and that centralizes it a bunch more because they technically would have control over your ASIC and not you. And I think going into the future, we're going to see more of a centralization to places, like we're already seeing it right now, a centralization to places that have low electricity costs, Texas being one of them, China, Russia. There's a lot of places that have very low electricity costs, and that is therefore centralizing these ASIC mining farms because they want to go to the best place to get the best profitability. And that is kind of a free market. Obviously, people are going to move to the place that brings them the most profitability. They have the money to do it, from way back, saving up money to build new facilities and get lower power costs. These things do tend to centralize, not a network as per se, because there's nodes running all across the world, but the mining side of it. And the main reason that we're kind of concerned about that is the 51% attack that could happen on a network. Now, I don't think it's going to happen to Bitcoin, but it could happen on smaller chains, and subsequently we could lose that coin even though it was really good in terms of the technology. I don't know how many 51% attacks have happened over the years, but I know of a few that have happened. We saw it with Lithium. That was very close to having a 51% attack with all of those FPGAs or ASICs, whatever it was. Those kind of came in, they held a bunch of the hash rate, and if they wanted to, they probably could have performed a 51% attack at the time. And that was all due to this progression as well. CPU, GPUs, people can buy GPUs obviously, but mainly when it hits over to ASICs and FPGAs, there's a massive jump between the two in terms of the hash rate. From CPU to GPU is not really that bad because everyone has GPUs, which means it can be more decentralized. But when it moves over to ASICs/FPGAs, it tends to get more centralized in that regard. I'm not saying it's a bad thing, I'm just saying these networks could be more decentralized on the mining side, but we are seeing a convergence to more centralization. The power costs, as I mentioned before, ASIC hosting facilities that would hold a lot of the hash rate. We're seeing it with Kaspa coin as well. These massive ASIC hosting facilities that are generating a lot of money, they normally get pre-orders of these miners from Bitmain or these big ASIC manufacturers. They would get it for a cheaper price than what you can buy on the consumer market because they're buying in bulk. And that basically further pushes decentralization there. So as the saying goes, you got to spend money to make a lot of money. And that is really what we're seeing right now. They're spending a lot of money on these miners. They're capturing a large amount of the hash rate. We've seen it with Kaspa. We've kind of seen it with Bitcoin, but that was more decentralized. And now we're probably going to see it with lithium, as we already saw it with FPGAs. However, there is new ASICs coming online from Bitmain that I'm sure some of these mining farms have already got allocations for, and they can get it at a different price. And talking about price, you can see here the GPU models, the ones that are the best right now, 4090, 4080, 4070. These are ranging from around 700 to 1700. You can get it at lower prices if you buy secondhand, but that's the range that we're going for. But when we go over to ASICs, you can see that the prices can be 5 times that price or even 10 times that price. A lot of home miners wouldn't necessarily have that amount of money on hand to just dump into an ASIC. It's a very big risk for them, but for these companies that are buying them, that's a smaller risk for them in terms of the capital that they have. This range is, 6,000, this top one for a lithium, 30,000. I know that price is going to come down very soon, but even 10,000 for a Kaspa ASIC is very high. Lately, the Bitcoin ones have been kind of dipping down. If we keep scrolling down here, the Hydro version of the S21 is only 6,000, and then if we keep going down, I think the S21 is only around $3,600. Now that is still a lot of money, but it's quite a lot less than what they were selling for, even the S19s. In the height of the bull run, they were going for maybe 15,000, even higher than that. So right now might be a good time to buy a Bitcoin ASIC. If you have the money spare, lock them away and then sell those actual machines in the bull run. But all that to say, I just want to make, the viewers aware and people give them information on the fact that we are moving or converging into a more centralized mining space at the moment. When these coins flick over to FPGAs and ASICs, we've seen it happen with multiple coins over the years. But some coins do elect to keep ASICs off the network, and that is a very valuable thing. And it allows GPU miners to go somewhere with steady profitability. There hasn't really been a coin that has done that recently. Raven coin is still good, I believe, but the profitability isn't really there too much these days. I think it can also be a strategy if you want miners to uphold your network, is to stop at the GPUs, make an ASIC resistant algorithm or just use a previous one, and then you'd see a lot more influx of steady hash rate across the network and more decentralization across the network, which is good because it protects against those 51% attacks. Let me know if you think I'm right about this or your thoughts in the comments below. I have just been thinking about it quite a lot lately, how ASICs kind of push this centralization inwards, and it's going to keep continuing further and further. But hopefully you guys agree. If not, please leave comments. I'm happy to or talk about if it is really the problem or not. Make sure you guys like the video and subscribe for more content like this.